bet you don't know a few things about 401k that I'm about to tell you. Welcome back to my channel where I talk about my journey towards financial independence while making a regular salary. So today I would like to talk about the things about 401k that we do not normally focus on and sometimes we just fly under our radar. And a quick disclaimer, this is not a tax advice. This video is for general information and entertainment purposes. You have to speak to a licensed tax professional in your particular situation. So let's just start with talking about what 401k plan is. It's your employer-sponsored plan in which you can contribute a portion of your salary. It's usually a smaller percentage, like let's say 3 or 4%. It can be a traditional or Roth IRA, so you either defer taxes or you pay taxes, and then eventually when you retire, you won't have to pay any more on the portion you contributed and the interest that you earn from that contribution. Typically, employers match your contribution by a certain percentage. For example, your employer matches 100% of your first 3% contribution of your entire salary. So let's say if you're making 100K, the first 3,000 of your contribution to your 401k plan will be matched 100% by the employer. So basically, you pay 3,000 and they pay 3,000 as well. Some employers only match 50%, but this is still great. In any case, you get free money. So normally, those companies do not give you the money upfront, although there are some cases when this can happen. Normally, there's a 2, 3, 4 year vesting period, and every vesting period normally has a schedule. So let's say in the first year, you get to keep 20% of your employer's contribution. In the second year, it's another 20 or 40, and it goes all the way up to 100. So typically in the first year, you will get the 20% of that 3,000 contribution that your employer has made. Next year, it's going to grow to, let's say, 40 or 50%. And eventually, over the course of 3 or 4 years, you will gain access to the whole 100% of the employer contribution. And of course, you can always just walk out with what you've contributed. This money is already yours. It was part of your salary. So this is for you to keep. So this is sort of an incentive for you to stay with the company. That's what we want. We actually want to keep an employee in the business for a number of years. They do not want to train you and onboard you so you can just walk out in the next 6 months or a year after receiving money from them. They actually want you to work a little bit more to get the full amount that they're promising at the beginning. In this case, you will get your money back, your 100% of the contribution that you've made in those years working for the company, and you will also keep a certain percentage of your employer's contribution. Normally, you could just keep the money in the same account with the same company unless you have too little in there. So some companies, for example, might have a $1,000 limit of which you can keep in your account. So if you have less, let's say 700, 800, they can automatically close your account. You will get the distribution and then you will be liable for taxes if it's a tax advantage account, and you will also be liable for the 10% penalty. That's a much less desirable scenario, but if this is what you're dealing with, then you'll just have to take the money, pay the taxes, and pay penalties. However, if you have more than that limit left in your 401k from your previous employer, you have a few options. You can either roll it to the new employer's 401k, so you get to keep all the money. It's not taxed. It just stays in a 401k. Another option would be to roll it into a traditional IRA, which could be great as well because you have much wider choice of investment options, individual stocks, ETFs, lower expense ratios. And finally, you can also convert it to a Roth IRA, in which case you will pay taxes on the money that you are converting. So we all know that before the age of 59 and a half, you have to pay the penalty if you withdraw from your 401k. But there are a few notable exceptions which you can take advantage of. First of all, there's a hardship withdrawal. This might be allowed for medical expenses if you have to pay your rent or mortgage to avoid eviction, funeral expenses, certain education and disaster-related expenses. Obviously, they're all pretty sad reasons to withdraw from your 401k, but that's when you actually need some extra money. So hopefully you don't have to, but in case you must, there's this exclusion, which can hopefully help you in those difficult situations. One thing to note is that you can only withdraw the amount that you really need. So, for example, if you need to pay a $3,000 hospital bill, you cannot take $10,000 and say that it's for medical expenses. Also, remember that you have to pay taxes on the amount that you withdraw, and just check your employer limitations in case if there's something else that will disallow this disbursement from your account. Next caveat. This one I really love, and a lot of people do not know about it. So you can actually give yourself a loan from your 401k account, and instead of going to a lender who will run your credit and their inquiry will likely be on your future credit reports, you can simply borrow money from yourself and pay yourself back with interest. Normally, the rate for such loans are premium rate and 1 or 2 extra % depending on who is servicing your 401k account. So normally the platform where you keep your 401k won't take any part of that interest that you're paying to yourself, but there are loan origination fees or administrative fees that can apply to your loan. There are also limits. This loan will not be a huge mortgage size loan. It's capped to 50,000. But if your total contributions in 401k are less than that, then you can only borrow up to 50%. For example, if you have 20,000 in your 401k, you can borrow up to 10,000 from yourself and pay yourself back. Just think about how awesome it is to give loan to yourself. You are your own bank and you make the interest of yourself. So you actually are not giving this money away. You're still enjoying the benefit of having the money that you otherwise would not have. It's still invested, it's still working for you, which is pretty sweet, I think. What happens if you borrowed from your 401k and you change your job or you get laid off? In this case, the loan will become due in 60 or 90 days after you leave your current employer. However, there are a few ways to avoid it. First, you can pay it back. So if you have cash on hand, you can just pay yourself back and just roll it over normally. Or you might be able to roll it over to the new 401k with your new employer. Of course, you'll have to research this information with your new employer and make sure that they allow such transition. So now we get to my most favorite part, which is solo 401ks. Just a few years ago, I had no idea that that would be a viable option for me. But upon researching, I found out that having an LLC or just being a solo entrepreneur gives you the opportunity to open your own 401k to which you can contribute as employer and employee. And what's amazing that the total contributions for 2026 that you as employer and employee can make to your own 401k is 72,000. And if you're over 50, you can also add additional catch-up amount, which is 8,000. And from age 60 to 63, you can add additional 11,250. So how does solo 401k work? Because you're both your own employee and employer, you can contribute as both. And your limit of contribution as an employee is 24,500, just as for any regular employee at any company. But then you can add almost 50,000 more as your own employer, which is definitely not an average match that companies offer to their employees. For example, if you're working for a company and you maxed out your 24,500 contribution, your employer can match first 3% of the salary. So they will give you additional 3,000. So your total contribution would be 27,500 for that year. However, if you're your own employer, you can max it out to 72,000 per year if your company income allows for it, of course. But there's one important thing to keep in mind. You cannot actually contribute 24,500 if you made less than that. And you can add up to 25% of your salary after half of self-employment taxes. So a good rule of thumb in this case, do not exceed 92% of your total compensation. If you have a side hustle like myself, you can put aside as much as you can. And this is so useful to know if your employer, like mine, does not offer 401ks. So you can actually take advantage of this tax deferred account while it's not available for your employer. So if you found this video useful, I will gladly take your like, or you can comment below, you can subscribe and follow me on social media. So happy 401k deferrals, and until next one.